Us now is Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, it certainly got everyone's attention when you pulled your S&P target for the year, because that's what equity strategists are supposed to do, is have S&P targets for the year. Why'd you do that? Was that a bullish call or a bearish call or what?
Sarah, that's not what we're supposed to. Hopefully what gets me the clients is the methodology that goes behind the target, not the target itself. I think it could be misleading. So let me give you a little bit of history of why I did it. In June, when the market was pulling back, it was having one of those two big pullbacks we had in June, if you remember them. We increased our target to 3,300 plus. And we emphasized the plus because you had a Fed in the background that was telling us that they were looking at how they were going to reevaluate inflation targeting and what that might mean. So in a situation like that, I wasn't sure what the upside multiple should be. And now I have a Fed that's telling us that we're going to have really zero interest rates for years, maybe for a very, very long time. And they're going to use the balance sheet. So I don't know what kind of multiple to put on an infinity Fed. I believe it's at least 20. So I don't want it to come across that I pulled my target because I'm negative. I have no idea. Should it be 22? Should it be 25? Should it be 125? We've never had a Fed that has told us that they're literally not raising rates for the foreseeable future and that they're going to continue to prime the pump.
Is that how you can justify, or other analysts can justify, these price targets going up and the levels at which you're seeing Tesla trade or Apple trade or other
right.
New IPOs, some of the competitors to Tesla that don't even have revenues? Yeah,
there's an excess liquidity. The reason I'm so bullish, I think we're in a new market and economic cycle that's going to last a long, long time, years. So I've also, as you know from the notes, we've been looking for a stair-step higher like the fall of 2009, where you had 4 temporary corrections ranging but from 3 to 7%. But I think the most important thing we can talk about, Sarah, is what market are we discussing? One of the second reason that I withdrew the target is it's being so influenced by the mega cap stocks that I'm not so sure it's representative of the economy anymore. Clearly, it is right now during a pandemic and a large shutdown. And if there's a criticism to me, it would be that I haven't recommended one sector with the mega cap stocks and only be in that area. So I just think that we're set up with this historic excess liquidity. Just by the way, how the summer of 2009 saw historic excess liquidity. If you couple that with a synchronized global pivot in the economy, and again, it's been wrong to date, I think it really benefits those economic areas that have seen such an underinvestment.
So Tony, it sounds like you pulled your target because of uncertainty as to where we could end up to the upside. What would make you reinstate a target because you wanted to have one that had some level of downside from where we are? What would make you bearish?
Well, honestly, if my clients wonder what my position is, or anybody watching the show wonders what my position is, I'm not doing a good enough job and the target's not relevant. If I think it's going to pull back, I'm going to full stop tell you. And we, August 17th, put out a note looking for 3 or 4 of these kind of 3 to 7% sharp 2-3 day pullbacks, followed by a move back up to the highs. So it's typically what happens. Remember, guys, what really creates that significant and sustainable downside is when you have monetary policy that creates a potential credit crisis or sets the stage for a credit crisis. Don't forget, last August, we inverted the yield curve. So credit conditions were not getting a lot better heading into it. It's why we downgraded our market view in January of this year. So it's really the backdrop where we don't know. The Fed is not going to act preemptively. They just told us that the now 8.4% unemployment rate is not something that's making them think about raising rates or changing their QE. They told us you can get to full employment. You can have inflation running hot above what their new average is, and they're still not going to raise rates. So I don't know how you guess what the upside multiple should be. Again, I think we're going higher after we correct some of the excesses that are out there, but it truly is an extraordinary setup in the macro backdrop.